So my question for you is now, what is your strategy? Are you currently involved in financial markets? In what way? Do you maybe have the ETFs? Do you invest in real estate? Do you invest in stocks? Maybe you have some bonds. Maybe you have a mix. Maybe you have gold, maybe Bitcoin, whatever you can have. It's all fine. Okay, some people say, I buy some stocks. That's great. And of course, it's about thinking about what it is. What is your strategy? I mean, you can buy some stocks and it's great if they go up, but what is it that you do when they go down? Okay, sit it all out, wait until the market comes back. That to me, that's fine, but at least you have to find out the answer before you invest. Okay, I want you to have a very simple answer. I always say to people, if you invest, tell me what you will do if the stock is going down. So what is it that you do if the markets are going down? And a lot of people then look at me and say, yeah, but stock markets, they will go up over time, isn't it? Yes, they did in history, in the past. But sometimes, like in Japan, you might need maybe, I don't know, maybe 10 years, 20 years, 30 years to wait before the portfolio is back up again. And so there you have to ask yourself this question, how do I approach? So investing is not about buying something. It's about thinking, what is my goal? What is my strategy? When do I get in? Why do I get in? When is it that I go out? Okay. Can I protect my investment? So I will tell you a little bit on how I do this and what my strategy is. So I want to approach this. But before I do that, I share a few lessons from the past. Okay. Now, this chart is a very important one. If you take a look at this one, it tells you the amount of return, what you would have made year over year when you invested for the last 200 years, because this chart starts in 1800. So if you, for the last 200 years, would have invested in stocks in the United States of America, your annual real return, so after deducting inflation, was 6.6%. So that might or might not be very shocking to you, 6.6%, but that's the average. Okay. Now, if you invested in bonds, which is again these loans, right, you would have made half of it. Bills, these are shorter term bonds or deposits on your money, or gold. But one thing I hope these people would never have done, which is a negative year-on-year result when you put your dollar in cash reserve. So if you put your dollar in cash, you lost a lot of purchasing power over the years. And basically $1 is worth 0.05 cents after 200 years. So there's nothing left of your purchasing power if you don't invest. Now, the great story is if you would have invested in stocks, you would have made the best return. Even even real estate is somewhere here in the middle. Okay. So the best place to go is stocks. This is what a lot of people know. However, I want you to zoom in and to understand the next chart. Take a look at this one. What you here now see is one of the biggest asset managers in the Netherlands, basically in Europe, is called Robeco. And it's not about Robeco. Here could have been any name, any bank name could be here. But Robeco runs a fund that invest worldwide. Okay, so they have a diversification of about 115 blue chips company. Now, blue chips is the name for the big companies, the really strong ones. Now, blue chips, by the way, anybody knows where it comes from? I know Chinese people don't like to go to the casino, but the blue chips in the casino, this is where this name comes from. The blue chip is the one that is the most important chip in the casino. So the worldwide stock market is about the blue chips, as they are called. So it's a big portfolio of the big names. Now, what you can see here is even these great guys, these clever guys from Robeco, asset managers, in the year 2000, when the market was going up forever, and then it suddenly went down, and they lost, you can see that here, in their portfolio, 62%. So they had a great portfolio, blue chips, the best companies. They had a great diversification. Everything was okay. They had handpicked these companies. And even with this knowledge, they lost 62% of their portfolio. That happened once. And in 2007, 2008, 2009, it happens twice because of this loss of 58%. Now, I want you to understand that the average return over the last 20 years might have been 6.9%. But the last 15 years, your average return would have been negative 2.1%. So basically, what this chart is telling you, that if you want to protect yourself, and if you, for instance, would invest now, and we would have something like this going down for 30, 40, 50, 60% or something like that, it might take 10, 15 years to come back. So I am not in this game. I don't like this way of investing, okay? And I found out, even if you take a look on this chart, that if you run your money with 8%, 8%, 8%, 8% every year, and you do that for the next 30 years, you make 8%, 100K will be 1 million in 30 years. If you manage to go by 8% a year, okay? Now, if once every 10 years you will have a drop of minus 30%, the gray line will be yours. So you go up for 9 years, you go down 30%. You go up for 9 years, you go down 30%. Now, if that happens only 3 times in 30 years, you will exit the game with 250K. So 100 will be 250K, or 100 will be 1 million. Now, what I try to show you here is that it's very important to do one thing, okay? Which is never lose money, okay? Rule number 1, never lose money. And rule number 2 is never forget rule number 1. And this is the message of, again, one of the big investors. Now, I can hear you say, yeah, that's an easy one. How can I make sure that I never lose money? Well, of course you will, every now and then, will have a drawdown. You will have a setback. That's normal. Everybody will experience that. There's nothing new to that. But what I mean here is that you have to be aware of the fact that if you lose, it is very hard to make up again. So if you lose, for instance, 20%, you need to make 25% to come back to break even. If you lose 40%, you need 67% to come back to break even. So if you lose 50%, you need 100%. If you lose 60%, you need 150%. That's almost mission impossible. So the point is, try to avoid these big drawdowns, okay? So what I learned over the years is, whether you have smart people running portfolios, whether you have a great diversification, whether you have the best portfolio, in the end, it doesn't guard you for a drop in the markets, okay? So you have to change your strategy. That's what I did. I changed my strategy, and I will always protect every euro, every dollar I invest, I will protect. How? I will buy insurance, and I will explain you in a very simple way a little bit later. Now, this to me is very important. And to show what I'm talking about is diversification. And a lot of people, a lot of asset managers, a lot of people with the banks, they have a strategy like the Robeco ones. Okay, they buy good companies, they go for the long run, and the bull market took it from here for the last 10 years, and everybody is a hero. But I know this was because of the bull market, not because of the brains. And a lot of people will find out the hard way in the next couple of years, I am afraid, because once markets are going down, they say, hey, why my investment manager doesn't sell because he sees that the market's going down? Why is he not hedging my portfolio? Why is he not doing this or that or so or such? I know all of that. I've seen that before. I've lived through these charts for the last 35 years. So I know what the mentality will be. I know what the strategy of these banks and brokers and asset managers will be. And there's nothing wrong with that. It just has certain consequences. And what I'm trying to say here to you is, whether you have diversification or not, once markets go down, basically everything goes down. Whether it's real estate, emerging markets, large caps, small caps, big companies, small companies, real estate, trusts, whatever, they all went down together. Now, there is a difference between 200 years and 20 years. And guess what? I will not live for another 200 years. That's pretty sure. I might live for another 20 years. And once you have reached a certain number in your life, and I hope you're all young and still have a lot of time to go, but even if you're young, you don't have 200 years. You have time frames like 20, 30 years. And in this period, you have to build your wealth. And if in these 30 years, something like a drop comes by, you have a little problem. So I want you to teach a strategy, a method where you can avoid these big drops. okay? And of course, it's not overly complex. It's no rocket science, but it's not simple that I can explain to you in let's say in an hour time, okay? So I do my best. I want to show you why I use a different strategy. I want to explain a little bit about it, so you have an idea of what we do and why we do it, okay? But if you have shorter time frames, you are more vulnerable, okay? Longer term, equity investments are attractive, that's for sure. The traditional approach, by the way, which is the diversification, sit and wait, is vulnerable, okay? Diversification is logical, definitely it's logical, but not enough to protect if you need it to protect your money. Stable returns need a different strategy. This is what I found out over the years, and this is why I set up my own strategy system, and this is something I want to teach people so that they can profit from it as well. Now, a few things I learned over the years. No matter if I have 35 years of experience, I know basically that I don't know. This is a great important thing to understand. I know that I don't know anything, okay? Because anything can happen. Whether it's a virus, whether it's a terrorist, whether it's a bookkeeper, whether it's a fraud, whether it's a whatever scam, whatever comes by, you have a lot of things that can happen to your money, okay? Now, if you look into the future, you will never know what will be next. You can have an idea, you can have a vision and an idea about it, but you will never know for sure. If you want to read a great book, it's called The Black Swan. The Black Swan is written by Nicholas Taleb. He's a professor, ex-option trader on the Chicago Mercantile Exchange. So he has a background like I have, but he is a great genius mind. And he wrote a book called The Black Swan. And I can definitely advise you to read this book. And what he tells in this book is that we forget about these what you call the fat tails, okay, the outside, the probability of something nasty happens, and what the impact of an event like this is going to happen. So it's going to happen to your what's going to happen to your money or your wealth. So we as human beings always think that something will be logical and natural. So we think the outcome will be something here, but might be a little chance, but something that happens over here, like for instance this virus, it caught us all, like the terrorist attacks, like the frauds or the scams, or suddenly something happens in the world. Maybe now Russia is going to Ukraine, and maybe another impact is coming. We all don't know that, okay? But basically I understand that I don't know nothing. And what I also understand, that even the stupid things that you think that cannot be true, it can be true. So everything is possible. Now, if you understand that everything is possible and you don't know anything, what does that mean for your strategy? So the only thing I could think of is, okay, I can only do one thing. I cannot tell what the market will do and whether I make a certain return in the future. What I can handle myself is not the return. What I can handle myself is the risk. So I have to focus on risk. If I manage my risk well, the return will take care of itself. That's basically my message, okay? So the focus should not be on return. The mindset should be, what is it when I'm wrong? What will it cost me when I'm wrong? And what can I do to protect myself when I'm wrong, okay? So what I do is I focus on continuous risk management, but I also focus on trends, because I need return. So I need to jump into a trend, get out on time, and try to avoid a downturn, or even better, try to trade the downturn and maybe make some money on the downturn as well. Easier said than done, okay? But if I don't focus on something like this, it will never happen. So what I will do is I try to translate market movements, trends, into a return for my money. But what I used to do with every investment I do, I calculate my risk return ratio, okay? And I'm looking for a special scenario, okay? I also want to wait for a certain opportunity. And the opportunities I try to profit from is something that I'm in a defensive way. I try to make money for the next 3, 6, 12 months, okay? So nothing for the real long term. My focus is on the next couple of months, okay? I want to make money each year, like the 8% each year. That's my mission, okay? How can I make 8% each year without a lot of risk, without losing 30, 40, 50, 60%? That's the focus that I have, okay? So this is what I'm trying to do, taking care of risk and hopefully the reward will come. Now, I will show you something. If I talk about a simulation, a scenario, this is a way I think and I can manage my money. Now, to give you an idea, this is a chart that tells you something about a position I have in Royal Dutch. Royal Dutch is the, of course, you all know that, Shell. You might be the petrol stations, etc. You might be aware of that company. Now, if I'm an investor, the traditional way, I buy a stock, and the blue line tells you what the stock, and in Dutch it's called an aandeel. Okay, what happens if the stock is going up, 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 up? I make return 5%, 10%, 50%, 20%, etc. What happens if it's going down? -5, -10, -15. And I always say a stock is like a rocket. It goes up like a rocket, but it also goes down like a rocket. Okay, I don't want to sit in a rocket if the market goes down. Okay, I want to be in a rocket if we go up, but I don't want to be in a rocket if the market goes down. Now, what you can do is you can buy protection, like a fire insurance on your house. If you buy a house, you buy a fire insurance. Why? You never know if and how and when your house is maybe will catch fire. Okay, you have no idea, but you want to protect yourself. So you buy a continuous protection in the form of a insurance. Now, this insurance is not for free. You have to pay money for this one. But the great thing about the insurance is that if your house is catching fire and losing value, a certain amount of own risk is there, but the rest of the risk you exchange that to the insurance company. You mitigated that risk. Okay, now the mitigation of risk is something you can do in the stock exchange. So you can buy a stock, you can buy an insurance, a protection of the stock going down, and this is not for free. It will cost you money, but at least you know for sure the first amount of risk I take for myself. Okay, fine. And if it's going more down, I will definitely lose a little bit more, but not like dropping like a bomb, okay, or like a rocket. So I can choose my own strategy. And this profile tells me this is my strategy. This is my simulator. If you go up, I will go up. Not as fast as a rocket, as the stock market. But I will be a bit slower, but I will still go up. But if we're going down, I won't fall down as the stock will do. I will manage my money and I will protect my investment. Now, this is my whole philosophy. Now, I want to explain to you how is it that you can do something like this, André. This is what I have to teach you. I'm willing to teach you. You can be part of the program. It's all up to you. Now, I show you a few components tonight, okay? So you have a clue of what we're doing here. Basically, what I tell you and will teach you is two things. I will tell you about a 80% defensive strategy. It's about wealth control. It's about the 8%, making 8% return a year. Actively managed portfolio of stocks. I'm looking for medium-term returns, okay? And I will structure my money with a hard protection. It's a philosophy on the 80% of your money. So if you come in and you have 100,000 to spend, or 1 million to spend, or 10 million, I don't know, whatever the amount is, doesn't matter. What is important is, if you have 100,000, for instance, take 80% and put your money and go for the 8% year on year on year on year. If we achieve that one, that is great, okay? But protect your money. Now, on the other hand, there's a nice game to play in the markets. You can trade. You can, if you like that, if you like to be involved in trading, you can make more money. You can make more returns. You can maybe make 20, 30, 40%. I don't know what. Hopefully structural. But don't lose your shirt here, okay? But on the other hand, we will focus on trading. So how to trade, looking for high potential, trying to have small risk and high leverage on your money. That's something I like also, because I've been a stock market trader and I like trading very much. But I know that over the years, if you have more money to protect, it's more important to focus on the 80% than on the 20%. However, in our program that we will do for the next year, I will combine the two and make sure trading is something completely different than investments. So investing is something completely different, has a different mindset, has a different attitude you need to have as an investor than as a trader. Okay, I will teach you both, and I will focus in first instance, of course, on the defensive one, And once we have that under control, we go for the offensive mode. Okay. Now, if we talk about trading, investing, it's basically about the 3 M's. We call that, I need to teach you a certain method. I need to teach you certain money management. And I need to teach you the right mindset. The 3 M's is basically the core behind our approach. Okay. If I show you this parachute, it means that the parachute is what I just showed you in this example here. The red line is where I put my money. The parachute is this. This is my parachute. It goes down, fine, but I'm on a parachute. I go down as well, but not as much. Okay. If I go up, I will not go as quick as my neighbor. That's fine. Good for him. But if I make my 5, 10, 15%, I'm more than happy. Okay. So it's a different mindset, a different approach. Now, I told you already that you can insure yourself against fire. Okay.